market structure, and we are going to talk about market structure and the type of market structure. So, what's the benefit of actually knowing what the market structure is? Knowing what market structure is going to save you from guessing in the market. When you understand market structure very well, you would come into the market knowing whether the market is buying or selling. So, in any given condition, in any day that you enter the market is always doing two things. And the two things are we have is either the market is trending or the market is in a stationary position. So it's either the market is trending or the market is in a stationary position. And if the market is trending, we have the uptrend and the downtrend in the market. So this is what the uptrend looks like in the market. Sorry about that. So this is what an uptrend looks like in the market. We have an uptrend, right? And this is what our uptrend look like. We have high, low, higher, low, higher, low, higher, low, and higher, high. So this is what an uptrend is like in the market. The market will be giving you series of higher highs and higher low, meaning the market is trading up, meaning the market is going up and actually not coming down. So that is what an uptrend is. If the market is trying to go up, the market is not going to go up in this fashion. It's not going to go up in a singular fashion. The market is actually going to go up in a multiple way. The market moves in a zigzag manner. So if the market is going up, it's not going to go up just like that. It's going to go up in a zigzag manner. So we have the high, higher low, and higher high. So this is what an uptrend look like. The market will be going in a zigzag manner, not going up. So this is what we call an uptrend. It means the market is going up, and there's a specific rule that guides this market when the market is going up. In an uptrend, the lows must be respected and not violated for the market to keep going up. So what do I mean by this? If the market is in an uptrend, if the market is in an uptrend, these lows, the market will be breaking these highs right here. The market will be breaking this high. We have higher, so the market will be breaking the highs up, taking the highs up. We call that break of structure. We are going to take that in the next page. So the market will be breaking the highs here, but these lows right here will be respected. The market will not break this low. The market will be respecting this low. It's very, very important and crucial for the market to actually not touch this low. So these lows will be respected. You can see that if the market is trending up, these highs are going to be violated. You see, the market is taking them up, and these lows are protected. When the market is coming back, it's not going to get to them. That is an unwritten rule in the market. When the market is in an uptrend, these lows must be protected. They don't need to be violated. They need to be protected. If the market starts breaking that low, then it's showing you that the market is possibly entering a reversal model. So you should not be looking at buying again. You get? So if the market is in an uptrend, the lows must be protected and the highs will be violated. And the same thing goes for the downtrend. We have a downtrend here. It's just the opposite of the uptrend. Opposite of the uptrend, we have a downtrend, meaning the market is selling momentum. Sorry, I think I made a mistake here. meaning the market is in a selling momentum, right? The market is in a selling momentum, so the market will keep giving you series of higher lows and lower lows. That's what the market is going to be giving you. So the market will give you higher lows and lower lows, lower highs and lower lows. I mean lower lows and lower highs. That's what the market will be giving you. The market will give you lower high and lower low. So the market will give you lower high and lower low, and it's the same rule that apply for the uptrend to apply to the downtrend also. These lows are going to be violated. These lows, the market is going to be breaking structure to the downside. After breaking structure to the downside, this high will be protected. The high must not be violated. They need to be protected. So that's the unwritten rule in the market. Is opposite, like this is equal and opposite for an uptrend and downtrend. Anything that happens on an uptrend is the opposite that happens in a downtrend also. So the lows need to be protected. They must not be violated for the market to maintain the perfect uptrend and downtrend. So we have the third situation that you can always meet the market in, which is the stationary situation. Stationary stationary. So what it means by stationary is when the market is consolidating, when the market is not breaking any high. It's not breaking any high. The market is just consolidating. It's showing you that the market is not moving right now. So you should try everything in your power to stay away from this market because the market is not moving. So this is a stationary market. The market is just trading within a range. So whenever you look at market, these are the three things that the market is always doing. It's either the market is buying, which is an uptrend, or the market is selling, which is a downtrend, or the market is in a stationary condition. So this is the first thing you need to know about the market when you want to start trading. This is the first thing you need to know about the market. The trading 101, you need to understand market structure, because understanding market structure will teach you how to identify the current state of the market. If you open your chart and you see the market making higher highs, higher lows, higher highs, higher lows, you know that you should be looking to be a buyer. You don't have any issue or you don't have any concern of where the market is going. You automatically know that the market is bullish as of that moment that you are looking at the market. And if you also see the market making series of lower highs, lower lows, lower high, lower lows, you know that the market is selling. So you should be a seller. You are not interested in buying. And if you come to the market and you see that the market is not breaking any structure, it's just ranging, it's telling you to stay away from that price action, because that price action is not what you are looking to participate in. You get? So when you understand this market structure and you understand these three things, you are already ahead of traders that are just coming into the market and guessing. So that's the reason why you need to understand market structure. It is very, very, very important for you to understand market structure. So let's move. I'm going to show you an example of a selling market now, a market that is in a downtrend, and a market that is in an uptrend, and a market that is in a stationary position. So this is gold, and as of this moment that we are talking about gold is in a very bearish state. Gold is a selling market. Gold is in a downtrend, and this is what it means. This is how you can identify this in your trend. This is a high, a low, a lower high, lower low, lower high, lower low, lower high, lower low, and lower high. So you kind of see that the market is moving down in a bearish manner. The market is giving you a higher high, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. And what is the rule that I said for the market? The market rules state that these highs must be protected. These highs over here, they need to be protected. You have this high over here, they need to be protected. The lower highs need to be protected. while the market will keep breaking these lows, these lower lows. The market will keep violating them, to keep breaking it, and it will be protecting the high. So this is what a downtrend is. So if you are looking to sell, you'll be looking to sell from here and taking your profit after breaking this structure. You'll be looking to sell from here and taking your profit after breaking this structure. You'll be looking to sell from here and taking your profit after market breaks this structure. So this is a downtrend. This is a downtrend live market situation. So this is what we mean by a downtrend in the live market situation. So now let's go to a pair that has been bullish. So we have this pair. This is a very bullish pair, and you see it's the same thing. We have this high, low, high. See, this low is a higher low. It's not breaking this low, and we have this high, higher high. It broke this high, and we have this low, lower low, not breaking this low, and we have this high breaking the previous high, and we have this low, lower low. We have this high also breaking the previous low. We have this low, lower low, and we have this high breaking the previous high. We have this low, the same thing as the low, and we have this high also going to break the previous high. So this is an uptrend. This is what an uptrend looks like in the market, and you can see the rules. We are breaking this structure up. We are breaking all this structure to the upside. We are taking all these highs right here. We are taking all these highs, but the market is respecting these lows, and these lows are not being violated. They are being respected. They are not being violated. You see, the market is respecting it. The market is respecting it. So this is what an uptrend also looks like. You have series of higher highs, higher lows, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. So this is what an uptrend looks like in the market. So now let me show you an example of what a stationary market looks like, a market that's consolidating, so that you will stay out of it. Okay, so we have so this is what a stationary market looks like. You can see the market is just ranging. The market is not breaking any structure to the upside. Even if it breaks, it's not respecting any rule. We broke this low, we came and broke this high, and we came again, broke this high, and we broke this low again. So the market is not respecting any rule. The market is just moving in a zigzag manner, and it is just ranging, not respecting anything. So this is what a stationary market looks like. So this is what a stationary market looks like, and it's telling you the market is not showing you a hand. So your best option as a trader is to stay away from this kind of market. Stay away from this kind of market, because the market is actually not showing you what it wants to do. The market is not showing you anything, so you should stay away from this market. So this is what a stationary market looks like. So the next thing we are going to talk about is we are going to talk about break of structure in the market. So what we want to talk about now after the market structure is break of structure in the market and type of break of structure. We have majorly three type of break of structures in the market. So a break of structure is when market is just moving to the upside down and taking the previous high. We have three types of break of structure. We have the single leg break of structure, single move break of structure, single move BOS. And this is how the single move BOS is. We have a high, we have a low, and we have market violate the high. This is a single move break of structure in a buying scenario. So this is a buy break of structure. This is a buy break of structure will break the structure up to this side. So this is what a break of structure looks like. In a buying scenario, it's just the market taking off the previous high. So this is a single move break of structure. And in downtrend also, we have something like this. So we have a single move break of structure, and this, you can see the market broke this structure cleanly to the downside. There was no retracing, it just broke this structure in a one move. So this is a selling break of structure. So this is a downtrend break of structure, single move, and this is a buy break of structure, single move. So we have the double move break of structure. Some people call it double break of structure, anyhow you want to call it. So have the double move BOS. And what a double move BOS is that you have a high, a low, a high, a low before the market actually going. So it's like a W-shaped break of structure pattern. You see the market broke this structure right here. But unlike this one, the market did not break the structure in a single move upward. The market broke the structure in a double move. So the market came down and break the structure. So it took the market 2 moves before it broke the structure. So this is a buy. This is the bullish single move, double move break of structure, and we have the bearish. So we have the bearish double move break of structure as well. So this is like an M pattern. You get an M pattern. This is a W, this is an M pattern. So we have the double move break of structure, and we have a break of structure to this side like this. Okay, so we have a break of structure. So this is like a selling break of structure. So this is a downtrend break of structure. Okay, so we have a single move break of structure, a double move break of structure, and we have the multiple move BOS. So this is the multiple move BOS, and let's say we have a market condition, we have a high, a low. You can see the market did not break this structure in a single move. The market broke this structure in a multiple move break of structure. You get, so this is the high that is going for the break of structure at right here. This is the high, this is our break of structure, but the market did not break this structure in a single move. It broke it in a multiple move. So the market moved multiple times before breaking the structure. So this is a multiple leg break of structure, and this is the buying. This is the buying, which is bullish, and this is selling. This is the sell. Okay, so this is the sell BOS. So you see, this is the sell BOS. The market broke structure to the downside in a multiple leg. So these are the legs of break of structure. We have the single leg break of structure, the double leg break of structure, and the multiple leg break of structure. So this is the condition for it. This one was a single clean move to the upside breaking structure. There was no pulling back. The market just broke structure in a single move, very, very clean move. And this one, the market went up, met a resistance, came back before actually breaking. So this is a double move break of structure. It broke structure here like twice, broke structure twice before getting here, and the same thing. And this is a multiple leg. The market went up, came back, went up again, broke structure here again, did some manipulation before actually breaking structure to the upside. So now let me go to the chart and show you what each and every one of them looks like. Okay, so this is an example of a single leg break of structure right here. We have this high right here. We have this high. The market came down, and we pushed up straight. So this is a single leg break of structure, breaking this high in a single leg upwards break of structure. So this is a single leg break of structure in a buying sense. So we have our break of structure here. Sorry. I have our break of structure here, and this is the bullish buying break of structure, and beside it also we have a selling break of structure, which is also a single. We have this low high, and you can see we broke structure with one clean move to the downside. So this is our break of structure right here, and this is our selling BOS in an up in a downtrend. So they are beside each other, you get. So this is a single leg break of structure selling, and this is a single leg break of structure buying, you get. So this is a single leg break of structure buying, and this is a single leg break of structure selling. Let's get to the double leg BOS buying and selling. So should I use this? Okay, so we have a selling break of structure. So we have an example of a selling break of structure right here. We have this low high pullback, and the market actually breaks structure like this. So you see, this is like the M pattern kind of stuff. The market was trying to break structure to the downside, but the market did not do it in one go. The market actually did it in a double leg break of structure pattern. So this is a double leg break of structure in the market right here, and beside it right here we also have the double leg break of structure in a buying sense. So we have this high low. You can see the market pull back before actually coming up here to come and break this structure right here. So this is what the double leg break of structure looks like in the market. You see this example, this is for the selling, and this is for the buying, which is the bullish, which is an uptrend, and this is the downtrend. So let me show you what the multiple leg looks like. Multiple leg here. So this is an example of a multiple leg break of structure pattern. So we have our high here. The market came back, created this low, came back, you see, before eventually coming to come and break structure here. So the market broke structure in a multiple way. This was our high, our initial high that we were trying to break as a break of structure. And look at all this market movement inside. We had this break of structure to the downside, we had another break of structure here, we have another one here before the market actually breaking the real structure to the upside. So this is a multiple break of structure scenario for buying. So this is a multiple break of structure scenario for buying, and sell. Let's look for selling. So this is an example of a multiple. So this is an example of a multiple, another example of a multiple break of structure on the selling downside. You can see we have this low, we have this high. Look at what the market was doing before coming down to eventually come and break this structure to the low side. You see the market went instead of the market to just come like this and go back down, the market actually created a small uptrend, breaking multiple structure before actually breaking structure to the downside here. So this is an example of what a multiple break of structure looks like. So now this is the third video. So we are going to be talking about dealing range in this one right here. So let's talk about dealing range. So when you have your high, this dealing range is very simple. It's probably going to be the shortest one. When you have your high low, you have this higher right here. So your dealing range, it starts from the beginning of this low right here to the highest point the move got to before retracing. So obviously we have a break of structure, right? We have a break of structure. So we have this high that the market got to. So this, from this high to this low, this is your dealing range, because when market retrace back, you are not looking at the market to break this low. If the market break this low, then this whole buying idea around here is very wrong. So you are looking for the market to retrace back and give you a buying opportunity around this place. So this is what a dealing range looks like. This is what a dealing range looks like around here. We are supposed to talk about point of interest now, but point of interest also has its own, like, it needs to be its own personal video, because you have a lot of point of interest. I have a lot of things that I use for my point of interest, so it's good. That point of interest is going to be the next video after this one, which will be coming probably next week or something. But this is what a daily range is here. So let me show you what a daily range is on the chart, and this will be the end of this particular video right here. So okay, so let me give you a quick example of this current sell that I am on BTC. So we have this low right here. We have this low right here, right? And we have this break of structure. Let me delete this. We have this low right here, and we have this break of structure. So this is what I'm saying. We have this low, we have this high, and we have break of structure to the downside. So after this break of structure to the downside, now from this high to this, from this low to this high, this becomes our daily range, because that is the range where we are looking for the market to respect. That's where we are looking to sell from. And you can see when the market came, it did not break this high, and it gave us a selling from here. Yes, so this is now our daily range. Once we have a break of structure and the market start reversing, then you mark your daily range from the highest point that the market got to and the lowest point it started from, and that range is your daily range. That is the range that you are looking to take your trade from. So that's going to be the end of this particular video. This is the first video of 4 of how I trade series, and it's basically breaking down the market to you in 4 ways. So the next video is going to be coming probably next week, or I don't know when it's going to be coming, but make sure you backtest everything that I just taught you. Backtest and see it for yourself how the market moves. Peace out. I'm signing out. See you on the next video, and make sure you subscribe to the channel so that I can also grow and be inspired to do more free stuff for you guys. Thank you.